European financial markets are steady this morning, with the UK's FTSE 100 index currently up around about 10 points. The DAX in Germany up around about 24 points, and the Euro Stoxx 50 index higher by 9 points. US stock futures are also slightly higher, up about 8 points for the Dow and only about 2 points for the S&P 500. When it comes to other assets in the commodity space, gold is up $4. Oil futures are also doing better. We have NYMEX up around about 30 cents and Brent up around about 50 cents at the moment. And finally, going into the FX space, we got a bit of a rebound for the US dollar, weakness for the Japanese yen, and a bit of stability for the euro. Going on to core government bonds, both UK gilts and German bonds are tracking a little higher. However, we are seeing a bit of selling pressure as investors take on a little bit more risk this morning. Good morning, I'm Ishaq, Siddiqi, and welcome to your daily market bite. I'm going to give you guys a quick idea of what's going on across the world when it comes to financial news and what's been shaking across markets in the US and Asia overnight. So we had a session in the US where a lot of the selling pressure started to ease. We've had a pretty for the last 3 or 4 days we've had a big rout across global markets, sparked by a number of things: the Fed's tapering plans, and at the same time the slowdown in China and the subsequent fallout for emerging markets, which has hit emerging market currencies and assets across the board. However, we saw a bit of the selling pressure starting to ease, with a lot of the US companies and stocks starting to pare back some of their losses and move higher in yesterday's session. That helped out Asian share markets as well in the overnight session, giving us a bit of a positivity going into the European session this morning. Now, we've got a number of things that we're dealing with in Europe. Today we had the PMI services number out from the Eurozone, which was revised a little lower, however, at the same time still pointing towards recovery in the Eurozone. A decent number on the whole, consistent with the recovery that we're seeing in the manufacturing component that was out earlier this week. So again, quite optimistic that the Eurozone economy is starting to grow. Although growth is tepid, it is a bright spot, given the fact that we are now having to contend with the idea that the China is slowing down, and in the US, although growth is on board, it still is fragile, and policy from the Federal Reserve is still somewhat questionable when it comes to forward guidance. Now, going on to what we're looking for today, we have the US ADP number, and that is seen as a precursor to the non-farm payrolls, which are out on Friday. We're expecting somewhere in the region of 200,000 jobs to be created by the US economy, and the unemployment rate to dip to about 6.5%. Currently, it's at 6.7%. For the month of December, which was reported in January, the figures were atrocious. Only 74,000 jobs created by the US economy. A lot of people thought that the number was distorted, given the severe weather effects playing a part in declining the amount of people being employed in the US. That's still going to be the case for the month of January. The polar vortex in the US in the eastern seaboard, and that's going to play an effect on it. But nonetheless, people do expect the labour market to continue showing a recovery in the US, and that is going to put a bit more pressure on the Federal Reserve to rehash some of their thresholds when it comes to unemployment. At 6.5%, if we do see a drop to that level on Friday, a lot of people will start wondering what that means for QE, and if we're going to start seeing the Fed pulling back a lot quicker than they are right now. Right now, we're getting $10 billion cut from the amount of QE every month. Perhaps the Fed may look at cutting a bit more if we have a much stronger number. Also on the agenda, we have the Bank of England and the ECB meeting tomorrow. Both central banks are going to meet to set rates and announce their policy measures. For the Bank of England, a bit of a non-event. People aren't really expecting much. We have the inflation report out next week, and it seems like a lot of the focus will be on the Bank of England to flesh out more of their forward guidance and talk a little bit more about what's going on with monetary policy next week rather than tomorrow. So a non-event likely to keep interest rates at ultra-record lows and QE at £375 billion. For the ECB, a bit more sticky. Turkey, the situation is tougher. They are now contending with two aspects. On the positive side, we're seeing growth out of the Eurozone PMI, manufacturing and services industry, and that's a bringer of positivity on the whole. But at the same time, we have to remember that inflation is dipping lower. This week, harmonized CPI for the Eurozone fell to 0.6%. Again, raising fears that we may be in a deflationary period for the Eurozone. If we do enter that, the ECB will be very, very worried and will have to stimulate the Eurozone economy by cutting interest rates further. And that is a base case for a lot of people in the market, that they may cut either tomorrow. I think it's unlikely. We reckon that, well, the market reckons that it's most probable that they will be able to, they're going to look to cut interest rates in March. That is all for your daily market bite. Look out for ECB, BOE, and the payrolls number out on Friday. So it's going to be a pretty risky few days. A lot of volatility in the market, and earnings are still going to continue coming thick and fast from both the US and Europe. Thank you for watching, and have a lovely trading day.